Welcome back. Broadly negative session on Wall Street. Let's take a look at the Dow heat map in a bit more detail. And it was really some of these economic bellwethers that did suffer because of the softness that we saw in the data, the private employment report and also the ISM manufacturing index. Case in point, GE off by about 0.6%. Alcoa trying to adjust to this new paradigm of softer growth globally by talking about the possibility of production cutbacks in their smelting division. That stock off by about 0.8%. Caterpillar in the same league down by almost 2%, and the banks faring pretty badly as well. JPM off by 2% as well. All right, let's get a bit more with Yudee Chang. He's Principal and Chief Advisor at ACE Investment Strategists. Yudee, good day to you. Do you buy into this sell down?
Wow, that is a good question. So do you buy into it? You know, I think this, on a very short-term basis, I'm talking about a week or two, I actually believe the market is going to continue up to make a new high. But if you look at the overall basis, I think over the next 2 or 3 month basis, I do believe a pullback is due. So as an investor, I probably wouldn't buy into this dip yet. I think this so-called sell in May, go away effect is going to take effect again this year.
Okay, so if you look at the S&P, Yudee, 1582 is where we closed off. If we are going to see a pullback, are we going as low as 1500, possibly below that threshold, number one? And number two, if it really is the data that is putting the cat amongst the pigeons in the markets, do you position more cautiously ahead of payrolls on Friday?
Yeah, I think you do. I think you do want to be a little cautious right now. If you look at it, the market rallied back in November, right? So from November to now, it's about 18%. Year to date, not counting today, it was up about 12%, right? If you look at earnings growth year on year, it's growing about 2.5%. So this market cannot sustain an 18% gain in about 4 or 5 months. So I think a pullback is due. So thus, like you said, right in front of the employment data, I will be cautious a little bit. You know, I just don't think, even if the market doesn't dip substantially right now, you probably don't have a lot of upside to go over the short term either. So you're not going to miss much by being cautious. Thus, I would be cautious.
Okay, Yudee, up until now, obviously looking at these charts, investors really haven't cared or reacted that much to the economic data because they've always known that the Fed is standing by in the background with the taps on. But the reaction to the ISM number I thought was interesting. It did cause a turn in the markets. Do you think that investor sentiment or psychology may be starting to shift a bit?
Yeah, I think so. I think you know, this the concept of the global growth is slowing down a little bit. It's starting to take hold a little bit. So I think a lot of people looking at the market saying that, you know, it has gone up a lot. And this, you know, we keep talking about this selling in May effect is there, believe it or not. If you look at the U.S. market, a research according to the Stock Traders Almanac tells you since 1950s, believe it or not, the month between May to October, the Dow Jones is only up about 0.3%, where the rest of the other 6 months, on the average, the Dow's up about 7.3%. Big difference. And not only in the U.S., but also research was done in 2002. Would you believe it? 35 out of 36 countries being researched, they have the same effect, where this time frame between May to October, stock market tend not to do too well. I think coupled with the fact that the market's already gone up so much, the economy is slowing down a little bit around the globe, and the fact that we have this selling May effect, I think that's why the market is pulling back and people are being cautious. Yeah,
pretty accurate every year, isn't it? It doesn't just rhyme. It seems to really reflect what happens in the markets, Yudee. How big of a deal is the ECB decision on rates going to be for U.S. markets?
Yeah, I don't think it's going to be that big a deal. I think basically they're expected not to do too much, even if they do something. What are they going to do? I don't think rates right now is a big factor, even whether it's in Europe or even the United States for that matter. I think the so-called QE also right now is not that big a factor either. Nobody really thinks QE is going to get pulled this year. And I think a lot of, on a CNBC survey, I think just earlier this week, 60-something out of 69 analysts are expecting some type of QE even in 2014, by the way. So I don't think rate decision is going to be a big determining factor for the U.S. market.
Yudee, this earnings season, the U.S. first quarter, cost discipline has been quite a consistent theme. So if the fundamentals continue to deteriorate, is that cost discipline going to extend to capital management? And do we have to be a little bit more cautious about some of the income-bearing stocks?
Yeah, you know what? I do agree. I mean, think about income-bearing stocks. I mean, as soon as they cut that dividend, the stock dips what? 8 to 12%. So you do need to be cautious a little bit. And also one thing that I realized myself, the volatility in the stock market has not gone up yet, right? But if you start to look at the precious metals, the energies, the currencies, volatility start to pick up. In other markets, usually, I believe, doing my research, that it has a lagging effect. So I'm expecting the volatility in the market, stock market, that is, to pick up a little bit as well. And usually, unfortunately, when volatility picks up in the stock market, usually means the stock market is heading to the downside. So like you're saying, all indications to us over the short-term basis is telling us to be cautious, You know, I think investors for this time frame do need to be cautious a little bit.
Yeah, one of the many puzzles out there in the market is the VIX and the volatility. Thank you so much, Yudee Chang. We'll have more with him in just a moment. We're going to leave you now with a look at how oil is doing in early Asian trade. Okay, let's keep it in the U.S. and get back to Washington, D.C. We've got Yudee Chang, Principal and Chief Advisor at ACE Investment Strategist, joining us once again. Yudee, we were chatting in the break about what your advice would be to people if they wanted to make a few bucks. And surprisingly, it's your bond portfolio that's doing the outperforming for you. Tell us about that.
Yeah, isn't it interesting? While everybody's talking about, you know, people are deserting the bond market and because of the possible end of the QE, the bond market is where it's performing, believe it or not. If you look at it, rate has been remaining low, thus bonds been doing well. So I think, you know, Lisa, when you think back a little bit, I think during time of uncertainties, is what we're in right now, right? I think diversification is the way to go. And if you really think about it, right now, to be anything of significance is really still the equity, the stock market, and the bond market. That's it. You're not really going to diversify into gold. I think that market is still a little too volatile and too much for me. So I think you need to sort of diversify between stocks and bond, okay?
Yeah.
I think bond market, a lot of talks about Fed ending QE, but it's not ending yet. So while they are not ending it, bonds still performing. So you keep it. You wait until that ends. But in the meantime, you do need to be in the stock market as well, because that's the only one that's also performing, right? So, but knowing the market, you're not just going to close your eyes and make a long-term bet on the market.
Yeah.
You do have to follow those sectors, roll in, roll out of it.
My goodness. I mean, we've been talking about the bond bubble bursting for a couple of years now, and it just doesn't seem to ever happen, and the Fed just seems to keep on rolling out the QE. What do you think the exit out of bonds will look like, Yudee? Will it be a slow, gentle decline, or is it going to be rough and fast?
Well, you know what? I think it's going to be a combination. I think initially it's going to be a slow and gentle decline. Then all of a sudden people realize, wow, Fed is really doing this. And then it could be a little bit more substantial. But again, you know, you look at Japan, right? Look how long interest rate has remained the same over there. I had other professionals telling me, oh, it's not the same. You know, Japanese markets, well, character is different. So I'm like, what's the difference? I mean, they got two eyes. I have two eyes. I have a nose. They have a nose. We have the same fear and greed emotions, right? So I don't think it's going to be different. So my own personal opinion is we're probably going to see low interest rates for a long time. Even if rates start to go up, Fed ending the QE, who says the bond market is going to tank? So I think the exit is probably going to be relatively orderly.
All right, so the Fed is staying the course, Yudee. What does this mean for the 10-year and yields? What's your year-end target on the 10-year yield speaking?
Yeah, very good question. I think 10-year is probably right around this level. Let's call it 2% or somewhere right around there. It goes up and down a little bit by using that target. I don't think it's going to change much, you know. And if you study history, you know, it really is so real. 1929, right? U.S. went into recession. And 1931, 2 years later, it came out of it. 32, the Fed prematurely raised rate. And then there goes the Great Depression. I think Bernanke, well, the Fed knows that. They really have learned that lesson. They're not going to prematurely raise rate until they see economy fully stabilizing and start to growing robustly. We don't have that, so they're not going to raise rates. I don't think so.
Okay, Yudee, tell us what investors should do with the Fed humming away in the background. We've got a little bit of a pause in the market. How much of a dip is realistic? Because people who've been waiting for 3 to 5% before getting in, they don't get it. The market just seems to go on without them.
Yeah, you know what, Lisa, if you think about it, the market do give you 3 to 5% dips. They really do. Last time we just had one, actually. What the market do not give you is the 7 to 10% dip that everybody really is looking for. So I think, same thing, I think if you think about it, so you asked me a little bit earlier, from 1600 back to about 1540. 1540 is about 4% correction, and if it does correct, that's the first level I will look at. And the next level is about 1380, which is about 7%. I really think somewhere between 4 to 7%, if we get a pullback, that's where it is.
Okay, Yudee, thank you so much, as always, for joining us. Yudee Chang, they're the Chief Advisor at ACE Investment Strategists. We're just about 2 hours away from the start of trade in Seoul, Sydney, and Tokyo. Stay with us. We're going to get you all set up for today's open after this.